About 7 minutes before we get started with trading here at the New York Stock Exchange. Let's get to today's mad dash. Gap is going to be a bit of a loser this morning after earnings.
Now, Richard Dixon's doing a very good job, but it seems like it's been inconsistent. This quarter Gap, for instance, the actual flagship was up 10%. But Old Navy was very disappointing, and that's the biggest. And because Old Navy was disappointing, the company they just slashed the outlook in a way that people were kind of shocked. Old Navy projected down in the low single digits and have been really, really strong. This Athleta business is just not good, down double digit now.
So what is the issue? Do we know?
Well, that was part of the difficulty, David. The issue was that they did not execute. Now, we have some headline which says that they blamed it on the environment and costs. No, it did not. I just have to tell you this. I have to correct things. He very specifically did not blame it on the environment. He blamed it on himself and on execution.
Okay, so they did not say it was a broader macro issue or consumer issue. They said it was an execution issue.
One of the things I don't like is when I hear that someone blamed the environment and they didn't blame themselves.
Right.
So it's like Julius Caesar. I mean, the fault was in himself. It wasn't the stars.
Got it.
So it was a jarring call because Richard is really fabulous in fashion. I do have him on tonight. And they caught some very big downgrades. Matthew Boss downgraded. A lot of people had really hoped that this was going to be the breakout quarter. He didn't blame tariffs either. I mean, they're going to get a tariff refund, but it just didn't get it done. And it was a brutal call, brutally honest call. I recommend if someone did not have a good quarter, this is the way to do it. But the guide down was done by the CFO, and it was disconcerting. Because if you take a longer-term chart, you'll see the inconsistency in Gap has been very unnerving. Very unnerving.
All right.
Yeah, I mean, real spending on footwear and apparel is negative. I'm not sure how you can't not look at that.
I wanted, and we're going to talk about it, I'm going to press him on it because when I talk to all the different retailers, those are bad categories. Yeah. But he would say, listen, I'm trying to bring in cosmetics. I didn't get that done. I didn't have the right look. And he said, or he did not say our team. He did not do any of that stuff. He puts it right on himself. And I like that, but of course I like better numbers.
We'll keep an eye. Here's a Gap looking down as much as 14 or 15%. Got an opening bell, a little less than 5.
When you look at how massive the margins are, certainly with what was reported yesterday by Micron, there's the benefit to the company, of course, when you have 75-80% margins, but somebody is eating the cost of that margin, and that is what's coming into the narrative a bit, and why I think analysts, particularly when you get into earnings season, are going to take a much closer look at that profit margin story, the productivity story, and the return on invested capital story.
And let's pivot here and talk about humans, particularly the consumer, and how all of this is affecting us. Because one of the things that really stuck out to me in your notes is that you pointed out that household equity ownership has reached more than 45%. That's nearly tripling from the lows that we saw during the financial crisis in 2008. So I have a twofold question here. One, does that make the market more vulnerable to corrections? And the second is, are households then systemically overexposed to an equity correction right now?
So this is a bit of a chicken and egg story. It kind of works both ways. So this rise in households' exposure to equities alongside what has been a very healthy bull market in equities since the bear market that we had in 2022 through the wealth effect has been a support for the economy. Where it potentially has the ability to sort of shift is if there is some sort of corrective phase in the equity market, more than just some of the dips that we've seen recently, does that feed its way into economic activity? And that's exactly what happened when you went from the late 90s into the early 2000s. You had the bear market begin in March of 2000. In 2001, we had an economic recession. I think that recession only came about because of the bear market in stocks. There were no major economic dislocations. There wasn't a financial system problem. It wasn't massively tighter monetary policy. It was the wealth effect once you went into a bear market. So I think we have to think of it as sort of, in multi directions, kind of that chicken and egg. It has been a tailwind. At this stage, I'd say base case is still as a tailwind, but it's something to consider.
Who's the EVP of Investment Strategist at Vista Shares. David, always nice of you to join us. Thank you so much for your time and also for stopping by in the flesh. It's always good to do this in person. What do you make of this rotation? Because it's been pretty rapid fire under the surface, between the hardwares, the softwares, the Mag 7. Does it make sense to you?
Yeah, I think what's happening and what we've really been observing in the market is a lot of macro pressure. And a lot of that macro pressure is overweighing some of the really strong fundamental earnings that we've seen on the micro side. And so what we kind of see is a lot of short-term volatility, and that short-term volatility is driven, by a number of things. And a number of things being, you've seen a lot of the oil prices out of the situation in Iran. Now that, obviously has a lot of implications, but specifically for the jewels of the AI supply chain, meaning South Korea and Taiwan. They're largely energy dependent, and that has a lot of pressure on, their currency and inflation. So it provides a little bit more volatility. So we kind of view this volatility that's happening right now in the market has given people a reason to pause, take a step back, and really look at the full AI picture and understand where do they want to position themselves within that. And what we've really been looking at is, finding some of those companies that can take what they've generated from AI exposure and turning that into actual durable earnings power over the long run.
Where is that?
Yeah, so I think a perfect example where you're starting to see that, really solidify itself.
We need to talk about why the recent weakness in semiconductor stocks may be creating opportunities, but also why the investors should not blindly assume that every pullback is ultimately a buying opportunity. Because under the surface of the technology sector, something important has changed. The stock that lead the market higher for a month has started to experience a volatile corrections. Memory stocks pulled back and semiconductor equipment companies declined. Momentum strategies experienced one of their sharpest short-term reversal in the years. And suddenly the investors who were worried about missing the AI rally are now worried that the entire semiconductor cycle may be approaching its peak. But when we look beyond the stock prices and examine what is actually happening inside the industry, the situation becomes much more interesting. The artificial intelligence infrastructure build out is still expanding. Memory demand remains extremely strong and hyperscalers continue investing. Semiconductor companies are increasing production capacity. New AI models continue launching and the demand for computing infrastructure continue growing. So the question the investor need to answer is not whether the semiconductor stocks can experience correction. Of course they can. The real question is whether the fundamentals growth supporting those stocks is beginning to weaken. Right now I don't think we have enough evidence to say that. Let's start with Micron. Micron recently announced a significant increase in its long-term investment plan for the semiconductor manufacturing in the United States. The company is preparing to invest an enormous amount of capital over the next decade to expand memory production and strengthen its supply chain. Normally, this type of announcement would make memory investors nervous because the memory industry has a long history of destroying shareholders' value through the overinvestment. Prices increases and the margin expand. Manufacturers become optimistic and build new factories. Supply increases and eventually the market become oversupplied. Prices collapse, margin disappear, and the stock get crushed. That's a historical memory cycle. And that's exactly why investors are nervous today. Microsoft is making enormous profit. That's good. Samsung is making enormous profit. SK Hynix is benefiting from the extraordinary demand for high bandwidth memories. These things are good for the memory sectors. But all the three companies are investing in additional manufacturing capacity. So the investors naturally asking whether the today's shortage is creating tomorrow oversupply. But there is an important difference between announcing new manufacturing capacity and actually producing additional memory. Semiconductor factories take years to build. Companies need clean room, manufacturing equipment, raw silicon wafers, advanced packaging capacity, highly skilled workers, customer qualification, and enormous amount of capital. Even after the construction is completed, the companies cannot immediately produce billions of dollars worth of advanced memory. Production need to ramp gradually, yield rates need to improve, customers need to test the products, and supply chain need to be adjusted.